Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day, how you going? Phil Tarrant, co-host of Property Investing Insights with the Right Property Group. Reshmi and Victor Kumar joining me in the studio. We're about a week or so beyond our usual scheduling. You've probably been sitting and waiting patiently for this episode of The Drop. Well, here it is, and apologies for being a week or so late. It's not my fault. I haven't been gallivanting around Europe over the last sort of 4 weeks, but I know two people that have done. Welcome back, guys. Good to see you.
Same here. We're just out there working on our 10. So.
Oh, this is right. Well, no doubt you've been looking at property right across.
If 8 years listening, yes.
No, but I think you guys are able to sort of disconnect and have a holiday.
Yeah.
Sounds quite nice.
It is important to recharge and relook at things and recalibrate. Otherwise, you do become jaded and get too bogged down in work mode without putting your head up and looking at where you are. And the same is true for portfolio as well, right? You can't be all, investing and not, forgetting to live.
Do you have that little, there's that subtle sort of anxiety in the belly? What's going on back in Australia? Is everything under control? Were you able to stay away from your emails? Because when you run at the tempo, it's, people talk about disconnecting. It's hard just to pull the plug out, right?
Yeah, it took him a while. It took him a while, actually. He had to let go.
Did you work on the plane? You didn't work on the plane?
No.
Yeah. That's cool. So highlight of the trip? Other than coming home and seeing me?
Highlight on the trip was actually having a meeting with council while we were in Europe. So this was in Italy time, 2 a.m., which was middle of the day over here, to have a meeting with council on one of our developments.
That was the highlight of the trip.
That was the highlight of the trip, yeah. Or we could say the low light of the trip as well.
Highlight because it was for
Was it successful?
It was successful, on many levels, no pun intended, because we pushed really hard to get the response from council, and when they responded, we were not going to let time zones hold us back.
Yeah.
This is the issue, right? So if the council gives you time when they can meet, you make sure you're there, because you got to march to the beach of their drum, unfortunately. But that's good. Well, you got an outcome, and it's good to see that irrespective of where you are in the world, you're still doing deals, which is pretty cool. But here we are, gang, on the 7th instalment of Design Your Decade. For those of you who maybe stumbled across this podcast series, is a special series we're doing. We've obviously been property investing insights now for many years, but there's a mini series we kicked off in January of this year, 2025. We did a sort of brief intro as we ran into it at the close of last year, as everyone was thinking about their Christmas break. So the 7th instalment of this mini series. Last time we got together, we talked about investor strategies, buy and hold strategies, build and balance type strategies. So I encourage all of you to go and tune into that podcast or any of the other ones in this special series. You can listen to them all independently. However, they're best probably listened to in sequence from Jan through to June. This is our July instalment coming out early August. We'll have our August instalment coming out on the usual schedule at the back end of August. But today we're going to talk about value. Reshmi.
Value. How do you value things in life? So that's important, right? And putting together a portfolio, it's not just about the property. That's a lot more that goes on with the property. So we're going to look at all aspects of creating a portfolio and how to see value.
And I always say value or beauty is in the eye of the beholder, and a lot of people view value in many, many different terms, and value is sometimes quite a unique thing. There is commonality when you look at it maybe at a detached level of a property, but what you can do and your circumstances will often dictate or determine value in a property, Victor. But most investors mainly obsess over price.
That's right. And we're putting very strong value on this podcast, because then to put value to it for the very first time, we've actually turned up with notes, right? So
Who would have thought?
yeah, I know, right? So there's always a first in the history of podcasts, and the reason for this was so that we could really make sure that we cover all the aspects. We've obviously been investing for a very long time. We've helped people invest for a very long time, and we see the normal pitfalls people get into when they're building up a portfolio. Look, anyone can buy an investment property, but to build a portfolio, you need to have the ability to recognize value. And especially when you're talking about designing your decade, we need to have that knowledge behind us to be able to truly design our decade. And this is where it all starts, is knowing what facets to value, what things to value in that process. And like you said, it's just not related to price.
So what then is, it's more of a philosophical question, but what's the relationship between value and building a long-term portfolio? So you're saying value is the central,
correct,
the central sort of aspect of it all.
Yes.
If you get value wrong, it's probably a better way to look at it. What happens?
Look, it does slow you down. It can take you off at tangents, and especially in today's day and age where you've got a lot of flashy marketing happening, you've got a lot of questionable videos on Facebook and Instagram. You won't get then detracted from your journey by these. You then dwell beyond the flashy messaging to look at the real message behind those videos. And there's some really good ones out there as well, where we can then say, okay, does it relate to me in terms of my journey? Does it relate to me where I am in life, where I'm in my portfolio? And it also helps you really put a strong, I'm trying to not use the word value, but strong value on the company you keep.
So it's a universal, present value across everything. It's really quite hard to actually put a definition on value, because value is something which is how you have a relationship with it. Is that good value? Is that bad value? Some person might think that's bad value, and someone else might think it's good value, depending on how and where you sit. So I think the best way then for us to deconstruct value is to look at in the sort of some of the parts of property investment, so finance, planning, tax, price, which is important, insurance, etc., and also with a view towards a long game. So let's kick off with finance, Reshmi. This is really the cost of value versus the value of leverage, two very different things, and everything interconnected with finance. Can you give me a sense for how you would shape a sort of value discussion when it comes to finance?
See, with finance, what I find is a lot of people have this thought that if I put in a lot more of the deposit, my debt would be less, so my repayments would be lower. Whereas when we want to leverage, so what is that value of that money? Like, you're putting a lot more of your money, whereas what you could be doing is leveraging off that money, so you could spread it across multiple investments, for example. And so that leverage is creating more value for you. However, you just have to make sure that it's the right investments and you're doing it at the right pace. So the amount of money that you're putting in towards one investment property, it's not producing you value by you could just spread that across and there's more value to be gained. So it's the understanding the importance of that money, how much are you putting into an investment and how much you can leverage off. So that's one way of looking at it. You can add on?
Yeah, sure. And so if we look at your standard approach in terms of finance, right, everyone's focused on the interest rate. And perhaps interest rate is the last thing you look at. It is important, but it's not as important as the other aspects of it. So if you look at a standard portfolio, so in the beginning years, you want to be leveraging hard and leveraging as high as possible. Then also understanding if you leveraged a bit too high, then you're getting into some cash flow issues because your loans might be turned from interest only to principal and interest, because the bank will want to hedge its risk, and it has its own policies, internal policies as well. So also then latching on to a good investment savvy broker that can take you to lenders that even at say 90% loan to value ratio would give you an interest only loan as opposed to principal and interest. Then also understanding that we don't want to equate the financing of the investments to how you financed your home, if that's the route you've taken. So once you understand those things, then we need to be looking at it from a viewpoint of, okay, is in the initial stages, you want to be making sure that your capital goes across as many acquisitions as possible without breaking the bank, no pun intended. But then as the portfolio matures, you want to bring in a bit of liquidity and a bit of the ability to tack away if things don't go your way. So you need to then start dropping your loan to value ratio down to 80%, right? So the value there lies in having a lower loan to value ratio loan as opposed to in the initial stages. So understanding that value along the way. And then if I go down the path of perhaps the self-managed super fund, right? The consensus most advisors may have that don't really think this through is, okay, let's go to 60% loan to value ratio. But now understanding how finance works in self-managed super fund, once you set the loan, you can't then increase the loan. So true value there really lies in perhaps paying a little bit more in terms of interest repayments in the initial stages, but going to the 80%. Now there are 90% loans, but then you need to then weigh up, okay, are the fees and charges that are involved with a 90% loan in the self-managed super fund, are they worth it? So I dare say that it would probably be 80% loan to value ratio in the super fund. And then it may be that it's principal and interest in that case, but we're understanding how finance works in there.
Yep. So it's like lender's mortgage insurance is another thing, like you know, not wanting to pay that extra to get access to the larger amount of money. So that's another, understanding the value of that. How if you by paying a couple of grand are able to access larger fund. So that's overall that is impacting on the value of what you're creating. So not having that ability to work that out, you're kind of limiting yourself. Yeah.
So look at the value of leverage. Just picking up something you said there, Victor. And maybe because I've just been doing this for a while, I just think, you know, everyone borrows at 80%. So, you know, you're putting 20% down and all the other costs. You're saying you made reference there to actually getting your loans to 80% LVR. So I'm assuming a lot of people start with higher LVRs.
They tend to.
Yeah. So they tend to. Like, can you give me a sense of? I'm just trying to make sure my perspective of this is correct. Of your client base. If they're relatively new to investing, will most be investing at 90%?
It depends on how much capital they've got to get started with. Because ideally, once we've bought the property, we also need to have some capital left over, right? So if by borrowing at 80% loan to value ratio, we are using up all of the capital and there's no buffers left, it doesn't make sense, right? But also the flip side of it is just as important. By going, say, 90%, it may reduce the number of lenders that are willing to look at you because of your particular scenario. So for you then, your value really in finance sits at the 80%, not the 90% mark. Yeah, and then also recognizing profession-wise, there are quite a few professions where the bank is willing to lend you 85% or 90% without charging you mortgage insurance. Right? So that has got extreme value that's attached to your profession. So understanding how to tap into that is really important in the beginning stages as well.
And this goes back to the point, it's probably philosophical or a mindset type issue where finance really is a tool for you to accelerate your buying potential. And there's so much value in that, but it's often overlooked. So what would you say to people then who have a reluctant relationship for whatever reason with debt or finance? They it's been instilled in them maybe some more conservative views around it. How do you sort of shift the needle in getting people thinking more positive about finance and being comfortable with the debt position or leveraging it? Reshmi, what would you say?
Well, I was thinking something like, people going back to the same banks, understanding the loyalty to the bank, right? So you're limited in what you can get, but if people understand the value of getting their money to grow their portfolio, they won't necessarily be going back to the bank again and again. So there'll be more opportunities of looking at others. So the conservative approach then goes, open your eyes and look at what else is out there. So that brings in a lot of value of what options are available to you. So if you look at the different types of products out there, different lenders are available to be able to give you that sort of money rather than you sticking to the same bank. So understanding that would open up a lot more options and would add value to your own life scenario and your portfolio.
Now, if we take that another one more step, right? So we're looking at what's happening in life, right? So it could be that they're self-employed and they really they've had a really good year, and the following year then now is not going to be as good revenue-wise, and therefore profits will be down. So latching onto finance, refinancing everything that in that financial year, when they can still use that tax return is really important. Then also looking at it from in terms of where they are in life, right? So are they just starting careers? Are they about to go into parental leave and therefore go down to one income and have added expenditure with another dependent? Or are they really looking at it from a viewpoint of, yes, we've got lending behind us, but now the banks might not like us as much because we are about to increase our principal place of residence mortgage. So all of those need to be taken into account, and understanding that, okay, if the bank's willing to give you quite a bit more money in comparison to the bank you're normally banking with, you would probably latch onto the new bank and allow your portfolio to develop, but at the same time making sure that you're not painting yourself into a corner where you've got massive lending with a particular lender, and these would usually be your third-tier lenders, and there's no way to tack away from them unless there is going to be a substantial change in the finance side of things. So this is where decisions through APRA come into mind. So they've recently had a meeting, and their thought process is that, okay, and this is the insinuation that they've given, that perhaps we'll go back to regulating or reducing or dampening down investment loans. Now, if we have that and we know that that's likely to happen, we want to maximize our financing now as opposed to when those policies may come in. So that's where you recognize value of structuring, recognizing a good broker that can help you build up the finance foundation. Because ultimately, you can have the best plans laid out for investing in property, unless you've got finance, which is why this is the first spoke in the wheel. Key. Unless you've got finance in place, you can't get anything done.
Yeah, so there's a lot of value in prioritising finance over everything else. That most people start looking at suburbs and whatnot,
or what they want to buy, how much they want to spend.
Yeah, got to start with finance, and I guess that sort of dovetails in with this next point in terms of understanding value, and that's planning and the value of having a map. This has largely been a consistent theme over the Design Your Decade sort of series, this value of planning. But it really goes in lockstep with finance. As a finance plan largely is going to help determine or maybe dictate your strategic plan in terms of how you go about building out a portfolio.
Absolutely. And so if once you've sorted out finance, you know what your borrowing capacity is, then you come back to, okay, can we then tailor out a personalized plan that then takes advantage of the finance that's available to you. And then it helps you not get swayed and caught up in if everyone's buying in Perth or if everyone's buying in Victoria. Is it for you? Because every state, every property comes with a holding cost, right? If you want to focus on the growth, it'll come with a holding cost. And different states and different types of properties will have more significant holding costs. So that then comes back into financing. How are we going to help with help hold on to the property? And also then helps plan out where we're buying, what we're buying, how we're buying, and at what speed are we buying.
Which is then allowing you to go and grow your portfolio coming back. So it's a how you plan now is going to tell you, what you're going to select and how that property is going to help you build your portfolio going forward. And if you're limited with funds, and if you have not planned, that's basically stress and loss of confidence. Yeah.
Yeah, and the best plans are those which help shape your direction and give you the mechanics to make good and informed decisions, but you're not wed to something too strict and robust. Like all plans change.
They change.
Of course.
Depending on the performance of the properties that you buy, depending on your life situation. So, having clarity and confidence and a plan actually giving you the peace of mind. So this is trust the process.
Yes.
But you need to manufacture the process, and that process typically is the plan.
Correct. And quite often you'd be buying counter-cyclically. Yeah, if everyone's buying in, say, Brisbane, you end up buying in Melbourne before everyone else starts buying because it makes sense for you because you won't be able to get into that market after. And so we're targeting initial growth and making sure that we obviously addressing cash flow. But then equally importantly, it could be that your finance dictates that you can only do set and forget investments.
Yeah.
You can't do granny flats, construction of granny flats, an example. Or your skill set dictates that we can value add by targeting perhaps the tired properties with non-structural renovations to then allow us to go back and recoup our initial funds to then go again, because you've got good buffers for cash flow, but you don't have enough capital. So part of the plan then, once you've sorted out finance, part of the plan then becomes, okay, let's create a buffering in terms of equity position first, and then we can then flesh it out in terms of how do we mitigate the negative cash flow we've accumulated along the way.
Yeah, and the negative cash flow is critical to actually understand the appreciation for what that is. And if you're comfortable with that, it gives you quite a significant accelerating factor when it comes to identifying growth assets, all the type of assets you buy. Do you still see value in sort of non-structural renos? Is the juice worth the squeeze in this market? I don't know. Back when we started investing, it was
perfect.
It was spot on, but it's sort of waned a lot lately to actually get the uplift required to make the difference, rather than just going, it's okay, I'll let the market do the heavy lifting.
Yeah, in most states, it dictates that we let the market do the heavy lifting, right? Because we're in an upswing. But let's say we are buying in Perth, where arguably the market in most suburbs is almost at a peak, if not beyond. You would help the value increase by targeting properties that do need a little bit of TLC, right? Now, the trick here is obviously recognizing that you want to be buying the opportunity, not the sentiment. In other words, don't get caught up with, because it's something that's got advertised as TLC, that you pay a premium for it, which you really, when market starts coming to a peak, those types of properties start attracting a premium as opposed to just a set and forget property.
But then you're playing an arbitrage game.
Correct.
Because you go, okay, well, I know that the maximum that we're going to be able to get for a 4-bedroom, 2-bathroom house in this area is $700,000. I'm buying this at $500,000. Time, energy, and effort, cost, materials, etc. Put it in there, and you get the uplift. And if that number is meaningful
to
you,
yeah,
value, great. If not, don't do it.
Yeah. So in terms of your portfolio and our portfolio, right? So in that example, having a 200K gross lift, but in reality probably a 50, 60K net lift, might not be worth the squeeze for us. Yeah. But for someone that's starting out, absolutely 60K is a lot of equity to gain net in that sense, because it allows you to then leverage onto the next one or create your buffer. Yeah. Whereas we've got our buffers in other properties that are more liquid or just as liquid. And so therefore we don't necessarily need those types of properties.
And there's also a value in that, the value of experience.
Yes.
Right?
Yep,
and that's a critical one. And I remember when we started investing, we'd work with you guys a lot out in the western suburbs of Sydney, doing a lot of those type of things. And the value of experience, it actually conditioned you in an accelerating factor to actually be a better property investor because you've done the time and you've made mistakes. And there's a huge amount of value in that. Often that's the unrealized value. It's the second and third order value.
You've been seasoned.
You become seasoned, conditioned maybe a bit, which is good. And by doing that now, I'm not really largely interested in doing that type of stuff to get a 60K gain.
Yeah.
But back then, 60K was like brilliant.
I know.
Could buy another property. Go again. Bang, bang,
Absolutely.
bang. And it's accelerator for...
Look, it's like, someone starting to learn how to drive, right? Initially, you are stickler to the rules in the sense that not advocating don't follow the rules. But, you know the rule book back to front. And then as you gain more experience, you know that, hang on, I can drive with one hand on the steering wheel. I can take this corner at 70 kilometers per hour as opposed to the prescribed 50 kilometers per hour.
You become complacent.
So you become complacent, but also you also know how much you can push the envelope, which is true in investing as well. And then it also the allure of driving also fades as well. So which is pretty much you and me in the sense of, the 60K uplift might not be worth it because it's lost its allure. Yes, it's going to be more of an inconvenience than anything else.
Yeah, because the amount of paperwork you've got to do to get the finance, to get all of that done, that's the value of your time and your effort putting in to get that finance to gain 60K.
Yeah.
So that's where your time and effort is now. Is it really worth it?
And the value of time for property investors, again, is often overlooked. And for me specifically, I always say I could have a much bigger portfolio than I could do because I don't deploy the time into it. I'm sort of inverse of it. I'm not spending too long over here messing around with property at the expense of other stuff. I'm doing other stuff at the expense of property. So
you're buying time because of the experience of others. Your advisors are who've got the time. You're buying that time because of their experience. So that's where do you value your time in your business and
Yeah, it's good when you have good advisors when you can call them from an airport and say, "Hey, I'm looking at this place. What do you reckon? Is it any good?"
And then he shoots it down in flames.
And he shoots it down in flames. Okay, great. See, it's nice to have. Not that most people would think there's not a lot of value in this, but the value of taxes. So the hidden value of structure again, often overlooked. Often overlooked. Most people get fatigued with the taxation regime for property investment. And I only saw over the weekend that negative gearing's being brought up again as part of this productivity commission thing. Here we are. But tax is just not a cost. It's an opportunity.
It is an opportunity, right? So first of all, understanding that when you're investing in property, you will end up paying tax, regardless of what structure you use, regardless of how creative you are. If the investment actually does its job, you will end up paying tax at some level, whether it is state, whether it is federal. So that's a given, right? So there's two certainties in life, death and taxes. And guess what? Even when you die, you still pay tax. Yeah. So the most certain thing is tax. So if you look at how tax planning more so than tax in itself, right? So that then helps you understand the value of owning property in individual names as opposed to joint names in each state, because then it actually gives you two land tax thresholds. So you are able to then hold double the number of properties or more to the point, double the value of land in that state. But also understanding that in some states you also have, say as an example, Queensland, you have a threshold for trusts, and you could hold multiple properties in multiple trusts. But then there's a flow-on effect of your negative gearing gets quarantined within that trust, right? So there's always a trade-off in whatever approach you take. It is a matter of mitigating the initial cost. The costs do catch up with you at some point in time in that journey. Now, one of the things that a lot of people focus on is, if it's a heavily negative cash flow property, you would put it in the higher income earner's name. Makes sense in the front end. So if we take stats into account, most people, if they're not having a planned approach, would sell their property, investment properties, within the first 5 to 7 years of ownership. So if you're now holding a property in the highest income earner, and if you were to take those stats into account, you sort of think, okay, you're going to get hit with a major capital gains tax. But not only that, most accountants would advocate go and buy something with a lot of depreciation. We need to ask them to tell the full story. And so, again, we're talking about team members a little bit later. But the full story on this is that if you've claimed depreciation, my understanding of this, and check with the accountant, if you claim depreciation on it, when you go on to sell the property, you're going to pay it back, right? So in other words, it gets added back into your sale price. So as far as the federal government taxation system is concerned, there's no free lunch. It's just deferred.
Everything in life is largely deferred, and and taxation for successful property investors, just get used to the idea that you're going to have to pay it. And isn't that a good thing, right? What a privilege to do tax. Where I see the hidden value, and there's probably negative value in taxation structures as well, and you may see this, and part of it is what I'm sort of seeing in the market just in general, Reshmi, is that people overstructure at the front end with a view to what the future might look like. And end up with complicated tax structures which largely are redundant, because let's look at the stats. Most people only buy a couple of investment properties, so you probably don't need complicated tax structures. The other side of it is that you end up with a tax structure which isn't appropriate for where you are at that point in life later on. And often that can be remedied, or as long as you identify and notice it along the way and you've got really good advice from an accountant and property strategist, you can actually maneuver into the right tax structure over time, which I've done.
Right? But guess what? You pay a little bit of tax at that time.
You do pay a little bit of tax at that time, and that's just the price of doing business. On the smart property investment portfolio, which you guys helped us build, and we'll have to do a stock take on that. We sold down a whole bunch of properties in a certain tax structure because it just wasn't relevant for us today, and yes, we had to sell properties and therefore the paid tax on them in a tax structure which wasn't ideal. However, it was through that journey that we realigned our tax structure or the vehicles which we hold properties to be more effective. So, you can't beat yourself up about it, because there's always a payoff somewhere.
Yeah, can I say something? We've talked about the structures and strategies, all the rest of it. But one thing I have found is when people talk about, I'm going to be paying too much tax on this property, and yet they want to invest. So the value about that, understanding that you're creating wealth and you're trying to avoid tax, you're trying to do two opposites, and it doesn't work. So you've got to really figure out what exactly you're trying to do and where is your value in that, so that you can stop thinking about the paying tax and think about creating wealth and how you're going to create that wealth when you've got to be paying.
It can be quite a negative force when all your decision making is built around trying to minimise your tax bill rather than maximising your value creation. So if you are thinking that way, it's probably not very productive, or you've got the wrong account. And by the way, I've seen a lot of accountants give advice to property investors which a different accountant would have given them probably different advice.
Yes.
I'm not saying that's right or wrong, but there will be a point in time when potentially the accountant that you have today might not be the accountant you go forward with.
That's true.
Right?
Yeah.
But
So
tax planning.
Just addressing the Freudian slip in terms of avoiding tax. Now we're minimizing tax.
Did I say avoiding? Did I say
Don't
avoiding?
avoid tax. It's illegal. It's illegal to avoid tax.
I didn't realise there's any avoidance tax.
It's a great Aussie sport to minimise your tax, and I think Terry Packer made that statement and legitimised that thought for everyone.
Yes.
But you got to pay your taxes.
No, I pay tax.
Now, if you look at from the tax point of view, right? So people they want to minimize tax over a period of time, and so therefore they look at the particular property. Then when you go on to sell the property, there is a tax event. But we also need to look at it as to in terms of that particular property. What's the real value? Which entity does it hold the most value? So if the plan, say as an example, is to put a granny flat on it then it becomes like cash flow neutral. And I'm making these figures up, right? So let's say that we were going to we bought it for 800 and we've spent another 250 construction loan to then build on it, or we've actually done a cash injection on it from another entity. So it's still borrowed from another entity, and it becomes cash neutral. Where is it best suited, right? So when you're looking at it from a tax planning point of view, we need to be looking at the entire journey for that particular property, but also it could also be that, okay, what's the intent to pigeon pair it with, right? So this could be a negative property or it could be a neutral property, and then we're going to pigeon pair it with a more negative property with higher growth because we've got another 20 years left in our career, and it's likely that at that point in time, then we will do what you did, Phil, in terms of selling down some, restructuring some ownership. And it's not the end of the world if you get the structuring wrong. There is obviously a cost involved in changing things, but perhaps not change too early, right? We get some asset planning into play in the tail end of your career to get that happening, because you'll have more benefit out of it at that point in time.
Absolutely. And again, you need a really good accountant around this, so I'd be seeking that advice for sure to make sure it's consistent with where you are, but where you may be going. And the whole thing around asset sort of planning is, estate planning is absolutely key. So we spoke about this very briefly, gang. The most overrated measure of value is price. So, you know, what are the people saying about me all the time? That tight ass pays twice, right? Just because something is cheap doesn't mean it's good.
Correct.
That's
That happens all the time. People probably say the same thing to you, I would imagine, Victor. I know you've got short arms and deep pockets. You spend your money wisely, mate. So, but cheap isn't necessarily always good.
No. It's cheap for a reason, right? So you need to understand, why is it cheap? And is it cheap for your circumstances? That's another question, right? It's an important question to answer. Is it cheap for the general population, or is it cheap for you?
Yeah.
Right? Yeah. And then also understanding, people get caught up in percentages in terms of it's got a 10% growth. It had a 15% growth. But you also need to be looking at what base are you starting with, right? A 10% growth of a 200K asset as opposed to a 10% growth of a 800K asset. If both the holding costs were relatively the same, I'd have the 800K asset any day of the week.
Yeah, and it's interesting value because it is, particularly around price, it directly correlates with the person who's doing the buying. And contingent value is a critical thing when it comes to price. You know, whether or not if you've got plans, you might own the property next door and another one's come up for value. And often you see people say, I bought it under market value. Well, that's a tough one to sort of frame, because the market value is what someone's willing to pay.
Exactly.
And then you'll see a whole bunch of people at auction. Auction's a great place to actually understand value, because a certain person will see value as X, whereas someone might have $20,000, $50,000 more for them to spend. And people going, they're paying over what it's worth.
I'll give you an example of an auction property where I saw value. This was in Minto with
Minnow.
It was an auction. I think we came up to 320, and I jumped my bid to 325.
No, so it was 300 and jumped to 325. Yeah.
Sorry. Yes, of course. 300
so this is like during the GFC.
325. Yeah. So 25K. And then basically what I know is if I kept bidding in $1,000 bids, everyone else would be bidding on $1,000. And that would have gone way above 325. So going from 3 to 325, it's a 25K jump. Once I've done that, it's a little bit harder for people to go 26K above what they were bidding at. Like going 1K more. So it's 26K in the human psychology, I guess. That's a little bit harder to work out, that how can I jump my bid now from 300 to 326. So that's when I secured that property at 325. And my value in that was because of the double, the experience and understanding how the psychology works. That gave me the ability to buy that property at that price when I know that it would have kept going more than 325.
And that's the value of a good auction strategy and a value of experience as well. Again, value of experience. And I've seen that at auction. I've done it myself where, you're just throwing a big
Big jump.
Big jump, and it'll rattle people, and they go, "Oh, it's funny how that works, right? It can really turn the heat out of the market." But that's you actually understanding the value and what you're willing to pay for something.
Absolutely.
Was that the highest you were going to go? You had a lot more in it.
Yeah, no, maybe a couple more, but
And it's the point with auctions that people mess around sort of bidding 500, 1,000, and you see it irritates the auctioneer. I don't know how many auctions you've done, Victor, but just going, look, this thing we all know is going to sell for 350 grand, so I'll put a big bid in it, 340. It's going to end up there anyway.
Yeah.
Get rid of the competition straight away. People are going to go, oh, I'm out. This
Yeah.
gone, right?
Yeah. It's a big hit, right? Because what you're trying to do is break the pattern, right? So if people get into the $1,000 bids, they very quickly lose where they are, and they just continue. I'm giving $1,000 more, $1,000 more, and a good auctioneer will milk that. Yeah. If we come back to price and understanding how value works with price, so it is determined by the tempo of the market as well. So before COVID, we would put value on a property as to whether we've bought it well, if we're buying it below its advertised price. Right. So normally most properties are advertised in a price range. So if you got below the lower guide, we bought well. Again, on the assumption and on the research that the property has actually been priced correctly, right? So if it's overpriced and you've taken 50K off it, have we really got value out of it? Probably not. Yeah, one would argue. So at that time, we are negotiating properties below the price guide. Now, as the market tempo has gone up, we're trying to keep the value in the price guide, whereas most properties are going well above the price guide. Yeah, so this is where understanding value in that market, also understanding, let's say you're young, say you're in the 30s, it's okay to pay 5K more, 10K more to secure the property, as opposed to 2 months later you're going to come back in the same market and pay the exact same price. Yeah. So understanding the market and understanding also where you are in terms of life, how much petrol have you got left in the tank from a career point of view, from a holding the property point of view, and getting into the market. It could also mean that your finance is about to expire, and let's say you're not going to get overtime again. If you're PAYG or if you're self-employed, it's going to not be such a good year. You'd pay a premium for the property to get into the market, because you know that you won't be able to get into the market for the next 2, 3, 4 years. So you're trying to crystallize and capture that 4 years worth of growth by paying a little bit more for the property, not being silly, but taking a calculated approach to say, okay, if everyone's going to pay 800 for this property, if I put in an 810 into this, I'm going to blow the competition out, so long as it's not an auction. I'm going to blow the competition out and get onto this. And then also putting a value on your conditions. Yeah. Condition being that maybe you've got rock solid finance behind you, so no finance clause. I'd still never renege on the pest and building. You'd always do a pest and building report on it. But making the contract that you're offering as hassle-free as possible has got extreme value. And you're taking the approach that, okay, if I were to buy at an auction, I wouldn't have a finance clause.
Yeah.
Right? So the bank would still value it. And I'm hoping that the valuation will come at contract price. And so that's the approach you're taking in a non-auction play, right? Now, of course, we don't advocate this if your finance is very, very contingent on several conditions. You don't want to renege on the finance clause. But it gives you that ability to get into the market, and therefore you're putting a higher value to that property as opposed to someone else who's got plenty of time. They can qualify for finance any day of the week. They'll want to pay 800 or below, whereas you've paid 810, 820 for that.
Yeah, it's a really interesting application of this sort of relationship between value and time.
Yep.
And people thinking that I've got to get the best price, and that's what the negotiation is all about. You know, it's counter-cyclical to think I'm going to just pay 10 grand more than anyone else. However, I may be able to apply terms of the agreement which gives me better capabilities to achieve what I want to achieve. You might go, yeah, I'll pay 10 grand more, but I want a 4 or 5 month settlement.
Yeah.
They may take that,
It
right?
may take
and over that period of time, the property may go up that amount anyway, and that gives you time to breathe and sort out everything out. So that's really the value of actually understanding what your end game is and knowing that. What is the value of what you're building towards, and it's the individual transactions that you take place, but then it's the aggregate of all of them together. So what are you actually looking for? And this isn't that there's planning, which is like I've got a plan to build this out, but this is what the outcome of that planning is.
Correct.
Absolutely.
Correct. Yeah. And the value is not necessarily in the price. It's the value is actually in securing the asset, without, of course, breaking the bank.
Yeah, absolutely. And again, experience helps you out with a lot of this sort of stuff. It's good to get moving with it, but really understanding what that end game is and the value of that, the value of time potentially with your family, the value of shaping and changing your lifestyle or providing a legacy or giving you freedom. Again, it's a very individual aspect of value planning. But something a bit more tactical, Reshmi, is the value of asset protection, trust structures, insurances, all this sort of stuff, right? Which most people overlook with insurances, and I occasionally still get a note from your team saying, I don't know if you paid your insurance.
See, you work very hard.
They send stuff directly to you guys. I don't know why, but
See, you work
Because I
all
know
this
you
time.
ignore your emails.
I look at every email. Do you know, I was listening to a thing, this is interesting, listening to a thing the other day of how the clinical diagnosis of ADHD, they'll ask you, how many unread emails do you have? And if you've got lots of them, that means that sort of you're a bit disorganised. It may be an indication of anyway. I have 0, by the way. I can't I cannot finish a day without an empty inbox. I may ignore them, but I have read them.
So does the 0 mean then OCD?
No, I think it means the other. It means that I think it means I'm okay with organising myself to be able to do that. Anyway, it was just something.
I'm massive ADHD.
Probably misinformation, no doubt. But anyway, this is not about a diagnosis of ADHD.
Oh, gosh. Well, look, you work very hard. You put all this effort in creating a portfolio, and at the end, if you have not done all this asset protection, what are you really working for? Yeah. It's all going to get wasted. And like you see so many situations where the property goes, for this, basically to be sold off, and people don't care about how, what is the real reason for you to build up this portfolio. So if you just don't go that extra step, you're really wasting time. You're not really thinking about what you're doing for the future, sort of, and your generations to come forward.
I was thinking about this the other day, Victor, and it's probably connected with what you're about to say. I've got this thing at the moment where everyone's talking about sort of critical infrastructure for Australia and all this really important sovereignty and protecting sovereignty and stuff. And I say that real estate or property is probably the most central critical infrastructure for Australia. It's where the value of most Australians hold their wealth. It's underpinned by the banks. The value of the bank's balance sheet is the mortgages that they issue to Australians, connected with property. The Australian government, all governments are connected with property as a way to generate revenue. Our superannuation funds put a lot of dough into the banks and the ecosystem around it. So property is absolutely critical. So, to ensure against that is I would say, a very smart application for everyone. AI and all this sort of disruption and crypto and all this sort of stuff, like, it's pretty hard for your property, the value of your property, to be taken away from you overnight.
Especially in the Australian banking system.
So to go those extra steps to be insuring at a functional level sort of makes sense, right?
It does, yeah. So a lot of people see that as a added cost, unnecessary cost of insuring the property and the ability to hold the property. So what do they mean? So obviously insuring the property in terms of its replacement value. The ability to hold on would be insuring your ability to earn the income and the property's ability to earn the income. Yeah, so they're the three basic things. Then you can add on to it depending on where you are in life and where you are in terms of wealth, in terms of what other insurances, what other asset protection vehicles do you use? Are you holding everything in a trust? Are you transferring everything into a trust? Because life changes, right? And then career changes, wealth changes. So we need to, what we started out with might not be, as you said earlier, might not be suitable. So we need to transfer. So yes, there's a cost attached to it, but the cost has got extreme value because it helps protect the asset base and makes it a lot more user-friendly, makes it a lot more liquid from a lending perspective, makes it a lot more better from tax planning point of view. So all of those things we need to be looking at, and it drills down, first of all, has to come back to finance and how the ability is enhanced to get finance. Then protecting the nest egg, so protecting the asset base, and then the ease of operation as well comes into play as well.
And keeping an eye on also knowing like if you've got the right insurances in place, because
Insurance costs change.
Yeah.
Yeah, they do. And being underinsured is probably one of the biggest issues. Yeah. I sometimes sit there thinking I'm overinsured, but I guess that's, but it depends again what your view of risk is.
That's right.
Is it the replacement value, true replacement value, or is it somewhere in between, right?
Yeah. Look, ultimately, people spend more money insuring their vehicles than actually insuring their asset base, right? And the vehicle, unless you've got a collector, it is a depreciating asset, whereas property bought correctly is an appreciating asset, and therefore you need to be spending money to help hold on to that appreciating asset.
Yeah, as little as possible. That's the game.
Yeah, of course. Yeah.
Secure it, put the protection in there so you can sleep at night.
You want to be able to sleep at night.
Yep.
You've got to be able to sleep at night because then you're probably doing the wrong thing if you're not. But therein sort of lies the connection and probably, again, a sort of overlooked value is the value of relationships. We spoke very briefly about it. This is the relationship with the people around you to help you make informed decisions. Relationships change all the time. And it's just not really the relationships you have with those people who support you on your property investment journey. It's relationships personally as well. I always say if you can have the home ground advantage, you can be exceptional, right? You can. It's very hard to fight on three fronts. If you're fighting at home or personal relationships, if you're fighting at work or if you're fighting in your property investment. And by fighting, I don't mean you're literally kicking off, but if it's not harmonised, right, that's really tough. It's very difficult to fight on two fronts even. But if you can sort the home front out, and if the home front is strong, and that's relationships, finance, mindsets, all this sort of stuff, you can do so much more.
Absolutely, yeah, because your foundation is rock solid.
Yep.
Yeah.
So that's something we see a lot of where the couples are not aligned, or they're going through a beautiful journey in terms of property investing, and all of a sudden their relationship starts getting onto rocky ground, and you can see the direct effect in terms of their portfolio and the decision making and so forth. So because the core aspect of property investing and wealth creation is now no longer there. So therefore, it has an impact in the decision making process. So really, we need to be looking at it from personal relationship.
Sorry, can I jump in? This is the value of the finance. Having it done correctly comes into play. If you don't do that right, it affects the value.
It affects relationships.
Yeah, I think it's one of the sort of major fractures of relationship is finances or different attitudes towards finances.
Or
I think
if
it's finance
cash flow becomes tight.
It's how you use money and how you raise kids, right? It's normally the two things. So financial pressure can put a lot of stress on relationships. So, it is the fundamental one. And we've spoken about this beforehand. Most people invest. Most people do it in syndicate. You're normally doing it with a partner, whatever your version of a partner is. Most people are investing side by side with someone else. So that relationship needs to be absolutely harmonised. Otherwise, you're not able to make the decisions which are going to be productive for long-term growth. And then that extrapolates out into professional partnerships.
True.
Yes.
Which, the value of those partners might increase or decrease as your portfolio unfolds, right? So initially it could be that your broker is someone that is okay for 2 properties maybe, and then after the third they're into foreign ground, right? So therefore you'd find better value in getting a different mortgage broker. Same with accountants. The accountants may have been really good in the beginning, but their business has grown, so therefore you're not valuable enough for them to spend time with them, and therefore vice versa.
It's funny how that happens,
Yeah, it
right?
does, it
That
does,
swing and roundabouts, right?
Yeah.
Your account might move beyond you. Your buyers, I see it now with buyers agents. I know you're still very tactical, Vic, but a lot of buyers agents move beyond their clients, right?
Yeah,
Because they go, I don't really want to do sort of discovery calls. I don't really want to do that
Yeah.
anymore. They get too big for their boots, right? But mate, you still got me.
Yep,
You know?
unfortunately.
Yeah. It's a lot of it. There's a lot in loyalty, right? And that's loyalty around your situation and circumstances. And the best value you can get from your professional advisors is to let them know what's going on.
Yeah.
Because only then they can provide the appropriate and most wholesome advice around it. So lots of different ways to view value, Reshmi. It's a lot more than just what you find on a spreadsheet. It's obviously... You know,
Absolutely.
the alignment is alignment of purpose, clarity, sensibilities, all this really good stuff that we've spoken about.
Just not on price.
It's
Not what you
no.
do. So what do you do about all this if you have the right attitude towards value? It's going to help you embark on a more positive property investment.
Correct. It helps you make sound decisions in terms of the portfolio.
I think you align your values. What exactly is your value, and how do you value things, and how do you see value in others, and how do you see value in everything else around you? And once you've got that right, there's-
Value alignment.
Yep.
People talk about it all the time.
Yeah.
And kids do it instinctively.
Yeah.
You know, in the playgrounds.
Yes.
You know, they'll hang around with other kids that have similar values. Now, that might be, they also like playing handball, so I value playing handball. There we have value alignment,
Yeah.
right? It could be as simple as that, or it's more sort of philosophical value. But property specifically, lots of different aspects to value. But I think it really starts is the value of good finance. If you get that right, largely you can
you should
navigate
be
the rest
okay.
of the other
Yeah.
stuff. Cool.
beautiful.
Very good. Good
Yeah.
chat. Long one.
It was. And so if you have questions, or if this has raised things that you wanted to discuss, we are just a phone call away, 1300 302 166, old school.
Wow.
But if you're new school, you can ping us on any of the socials, and we will definitely be in touch.
And please keep the reviews coming wherever you're tuning into this, whether you're watching us or you're listening to us in the car. Don't text while driving. Wait till you stop. But you know, just to round that out, I've touched on some points here which resonate with people, and this point around, you know, there isn't a value alignment in a property investment decision making, or value alignment in terms of wealth creation. No doubt you guys get used to help educate.
We do. That's part of our process.
Yeah.
So that's why the amount of questions we ask in our consultation is, I mean, people must be wondering, why do you need to know all that? But if you want to be successful, we need to know all that.
You work it out
So-
pretty quickly. You go, there's certainly there's the value disalignment here between these two people. Can you pull them together through education? Usually?
Look, you can,
Yeah.
because if you bring it down to what they're really trying to achieve, right, and strip away all of the flashy stuff, then you can, yeah. But there are some people where we turn around and say, you should not be investing right now. You need a lot more of the foundational knowledge built in first before you even start investing.
A lot of people have legacy. When we're talking about finance being an essential thing, most people aren't investing in cash, right?
Yep.
They're using debt. So a lot of people have a lot of legacy issues or concerns around debt, whether it's misinformation, disinformation, or trauma. You know, a lot of people have sort of financial trauma in their past.
Yes.
Their families, particularly people who didn't grow up with a lot of money, or they've seen, you know, fortunes get lost, or circumstances like that, right? It'd be very, very tough.
It would be.
Yeah. Speak to your broker. Speak to the crew over at Right Property Group. These are all the sort of conversations you should be having in order for having a constructive outlook when it comes to wealth creation. rightpropertygroup.com.au is where you can track these guys down. I hope you enjoyed today. That's our 7th installment of Design Your Decade. Next, you're going to give us a little insight.
No, we'll
on-
keep it a mystery.
Okay. It's going to be a mystery, but I'm sure it will be good. Are we going to go the whole year? The whole year? We're gonna do
More than
12?
likely, because
12.
we need to be, now that we've given the Design Your Decade concept, right? We now need to build in the foundational knowledge behind it, so that then people can actually implement what we're teaching. Of course, it's not a flashy approach. This is grounded, well thought out, years in the making, and it is something that both Reshmi and I have done personally, and therefore it's not something that's out of a textbook.
Yeah, absolutely. Thanks for tuning in, everyone. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.